For 25 years, this is really big picture. By the way, happy to talk to anybody offline. If any, Diana's got my contact information. Give me a call this week or next. For 25 years, we've had a situation where globalization, demographics, and technology advancement have been disinflationary factors in the economy. We're losing globalization. Bob Gates 2 weeks ago had a comment where he basically said, the holiday from history is over. So what we're going to be looking at for the next 25 years is a retrenchment and probably less globalization, which means that inflation is going to be something that the Fed is going to have to fight on a regular basis, much more than it ever has had to do for the last 25 years. The Fed statement today is now citing the Ukraine crisis as well as supply chain obstacles as a source of inflation, and it's pretty much given up the ghost in terms of COVID. We now expect inflation to remain above target being 2%, for at least 2 years. The Fed thinks we can get back there within 2 years. I'm very skeptical that's going to be the case. The market is planning 7 to 8 increases in the Fed funds rate between now and the first quarter of 2023. I'm skeptical that we're actually going to get all the way, because what's happened here, and this is my last minute, Diana, I promise, is that when you think about what the Fed has done, it has basically increased its balance sheet over the course of 23 years from $100 billion to $9.4 trillion. What that effectively means is that all the other factors that go into what is a neutral rate of interest is almost superfluous to what the Fed decides to do with its own balance sheet. And so a lot of the media reports you're going to be seeing in the last 24 hours and the next 24 hours will be the Fed funds rate. What are they going to do with rates? The key is that's important, yeah, but the key is to look at what's going on with the balance sheet, because the Fed is very concerned about inverting the curve. Inverting the curve means that your 3-month rate and your 2-year rate is higher than your 10 and 30-year rate. When that happens, there's a exceptionally strong correlation to a subsequent recession. So the probability, key takeaways, the probability of a recession here in the next 24 months has gone up. Inflation is going to be more difficult and challenging to control. The Fed is going to have to rely on its balance sheet operations as much as it is on Fed rate hikes in order to try to execute a soft landing. Sticking a soft landing in this kind of a challenging environment is going to be very difficult for the Fed to do. I think they basically went too far, assuming that the disinflationary environment based on those 3 factors I mentioned would continue indefinitely. And when we see things like the coronavirus, the shutdowns in China, Ukraine, and a lot of other factors, we're looking at a world where macroeconomics are going to basically return to what they were traditionally prior to the turn of the century. And that was one where we didn't have quite as much globalization as we have now, and a more of a reliance on domestic consumption, domestic production, and trade. I wouldn't call them wars, but disputes are likely to increase. In that environment, I think we expect a lot more volatility going forward. I wish I had better news on that score, but I don't think this is going to be. I think the volatility we're seeing here, certainly today, certainly in the last month, even regardless of what happens on Ukraine, hopefully the tragedy it gets a little better over there. We're going to see a little more volatile economic conditions over the course of the next couple of years.